We're heading into the last trading day of a wild, wild week. To get us through this, we're joined by David Dietze and Jeff Sica, who are staying with us. David, first to you. Look, a wild week. Give these people some advice. What are they supposed to do, those viewers at home?
Well, it's all about your asset allocation and your risk tolerance.
What's that mean?
There's some
asset allocation. What does that
basically mean? It means since 1987, we've seen drawdowns between 36 and 54%. And each time the economy looked great, but the Fed started tightening. If you can't withstand a bear market 20% or more, then you need to start pulling back. But if you've got a decent asset allocation, there's some tremendous bargains out there, and we are buying them today for our clients.
I don't understand that at all. Now, look, tell me straight. For our viewers, you're saying that they should get out of some stocks, sell now, and go into others?
If you are too far over your skis, if you've been taking on too much risk just to get 1 or 2% more income, if you've been betting on continued very low volatility, you've got to pull back. But if you have a careful allocation between cash, stocks, and fixed income, now you're down 10% in stocks because of the recent movement, get back in there, get back on your horse, and buy some good stocks with strong fundamentals.
Oh, okay, now I understand. So if you got some cash on the sidelines, look for bargains and buy them.
Absolutely.
Why didn't you say that right now? Okay, Sica, advice for our viewers.
Well, the first thing is that this market, which has been characterized by high levels of complacency, I agree with David on the asset allocation, but the fact is most people have between 80 and 90% in stock because they've been completely starved out of the bond market.
Okay.
They're too heavily allocated in stock.
Is that too much?
Yeah, because here's the problem.
Would they sell now?
I think if you're close to retirement, if you're within a few years of retirement, you have to look at, are you going to be able to endure a big decline? Because we could be on the verge of one.
So this is not going to bounce back to where it was?
You're going to have a lot of volatility. And what I would say is that don't be like a dog chasing parked cars and chase this because you are going to be steamrolled by the professional traders.
Here's the numbers you should keep in mind. For the last 9 decades, the S&P 500, on average, every 6 months or 7 months or so, corrects down 5%. Every 2 years or so, it corrects down 10%. But then on average, the swing up is a sweet double digit near 12%. So it'll go up and down depending on your asset choices, but a steady rise up in the market has been the story.
So history tells us that when you get a nasty, sharp move down, hold on for a couple of years, and it goes back up to where it was. Is that accurate? No, I mean, yes, a couple of years, you have to be honest.
10% goes down every 2 years or
okay, but back in the crash of '87, you were there, I was there.
I remember it well.
I believe we recovered from a 22% single-day drop
almost
within 2 years.
23% on that one day.
We were back where we were within 2 years.
Yes.
That's worth remembering.
And there was no recession.
That's right, there wasn't. That's right.
Yeah.
And that's true. It's all about time. But keep in mind, you have a lot of investors now who haven't even acknowledged the fact that markets do, in fact, go down. And those investors, it's all about psychology and behavior, and those investors need to behave rationally for this thing to work. So I would not have too much confidence in their ability to behave rational because they haven't acted rationally up to this point.
You could argue that perhaps some of these stocks were overvalued in January, but could you argue that now after this week? I don't think so. I think there are a lot of really good... Look at the financial sector. They took a hit yesterday. The financials are going to do very well once the dust settles with the lack of regulation, more higher interest rates, they get more money back on their loans. I think there's some real value to be had now.
Yeah, but that spending bill that Congress just whooped through, I mean, this comes at a time when the president wants to do a big infrastructure spending and the Federal Reserve is selling off its treasuries off of its balance sheet. This is like one big soapbox derby in the bond market with crack-ups coming.
That means rates are going up.
It could yield to get more investors to attract them into those bonds.